Good morning, Wall Street winners. It is Thursday, March the 27th, and what we were hearing in the news this morning is more Trump tariffs. So we heard last night, actually, after market close, that Donald Trump has imposed his 25% tariffs. He really wants to bring automotive manufacturing back to the U.S. He's trying to encourage manufacturers to create every single component in their cars in the U.S. And if they do that, then anyone in the U.S. who purchases an automobile in the U.S. and finances that automobile will be entitled to write off the interest on that. That's one of the things that he is looking to implement moving forward. That said, it is causing upheaval amongst the auto sector. It appears that of the three big U.S. car makers, Ford, GM, and Chrysler, Ford is going to be the least affected by these tariffs, but GM and Chrysler will be very affected. And then obviously on European imports, there's going to be a tariff. So those cars manufactured in let's say Germany or France or other parts of Europe and sent over. Ferrari is an example. Not that you're probably struggling if you go to buy a Ferrari, but those will have an import on them as well. My dog is disappointed because he's a car lover and he really wants to see the import tariffs go away, but he'll just have to make do for the time being. If we take a look at the markets, what we can see in the futures is the futures have actually come back. I'm a little surprised, to be honest. The NASDAQ is down 48 points, which is 0.24%. The S&P 500 is down only 9.5 points, which is 0.1%. And the Dow is actually up 30 points. Now, I expect this is going to change. We had some earnings out yesterday from another of the financial companies that we follow. Let's jump right down to that just to start, and that was Jefferies. And Jefferies is down in the pre-market to the tune of 5.5%. They had worse than expected earnings, and as well, they had a poor future forecast. There are concerns about the outlook for M&A. We just haven't seen any real talks about deregulation in banking, which was one of the hopes coming out of the Trump administration getting into office. And that was probably hoped to be an earlier type of discussion, but the focus has really been on trade and tariffs as opposed to any discussion around banking. And that is maybe putting a bit of all the uncertainty is putting a pause for sure on the M&A business and a slowdown in that. And then Jefferies came out with worse than expected wealth asset management numbers and trading numbers. So we're going to have to see whether that actually transitions into the big names set to report in a couple of weeks. And those big names obviously being JP Morgan, Morgan Stanley, Goldman. They all dropped yesterday. If we take a look here at the Yahoo Finance app, you can see the VIX is still below 20. Crude rose yesterday. It dipped this morning. It was up previous, and then it dipped, and now it's back up, but only a penny. You can see as we move across the screen, the VIX is below 19 right now at 18.5. And as we move across the screen, that's what we've got there. And then we get into health and retail. Again, I would be completely avoiding retail right now. I think we're going to hear from Lulu this afternoon. There's a potential for a pop, but you got to look at what happened in the last couple of days. In the last couple of days, we had two, we'll call them dog pet-related companies, Petco and Chewy, report, and both of them had great results. Chewy actually dropped after great results. It was just dragged down by the overall negativity and pessimism in the market. Petco popped after hours, and we'll have to see whether that holds into the morning session. But even a stock that is outperforming and has positive future forecast and is growing as expected or greater than expectations, normally those stocks are the ones that will pop during earnings, and these stocks are not doing that right now based on the market sentiment and investor sentiment overall. Investor sentiment, it follows closely to consumer sentiment. So as we've said multiple times on this channel, consumer sentiment is what drives the U.S. economy. Consumer spending drives the economy, and sentiment drives the spending. And we're not seeing that, and hence we're seeing a pullback in investor sentiment as well. And when we look at the data in the U.S., the majority of consumers propping up the U.S. economy are the top 20% in the wealth bracket, and those are probably the individuals who are experiencing the losses in their investment portfolios right now to a greater extent with the correction that's going on. So because they're not seeing growth in their investments, maybe their salary remains the same and they're not affected by job loss, and they're able to certainly carry their costs. So they're beyond the bottom tiers of, say, Maslow's hierarchy of food and shelter, and all of that is covered for them and they don't have to think about it. But when it comes to discretionary, they now are rethinking what they're going to be spending on and when they're going to be spending it. So that's where we are with health and retail. If we go down to transport, it had a good day yesterday, but for no good reason. Oil is on a bit of a rebound, both crude prices, futures going out into May 25th, but also the oil refining companies. So you can see that it was mostly green on the screen yesterday, and it looks like it's shaping up to be a potentially positive day today. The one energy stock utility that's been hit over the past few days, and again, not sure of the reason, but for an almost $8 drop yesterday in Vistra, which is a utility out of Texas, that's a big drop, and again down 2.5 today. That's going to make it basically a 10-ish% drop in just 2 days. Now this stock has had a huge run up. It fell down to the low hundreds and then climb back up to the 130s. That's like a 30% gain right there. So not really a good reason for that, but others that have had a pretty good gain. I mean, Con Ed has gone from 100 up to, call it 108 based on where it is now. So oil is an interesting one where there's some volatility within a range, and that's kind of what I'm looking for these days. I want to avoid the stocks dropping below their range bottom. I don't mind if they're bouncing between a lower and an upper range, because that provides an opportunity to make some money on those. But if it has the potential, which everything does, but has more potential, let's say, to drop below the bottom of that range or bottom of the envelope, then I want to avoid those. And tech is falling into that category right now, where the bottom can fall out pretty much at any time, and it looks like it's going to be another red day today. So this is another example of what I've been talking about on the channel over the last month or so, and that is to, when the markets are green, which is not today, buy puts on things like the QQQ. So I bought a put the other day. It went up. I was in a losing position after day one, but after days 2 and 3, it looks like I'm going to be in a green position. And the returns on these puts and options are a lot more with a lot less capital. So I could be up 24 or 48 or 50% over the course of a short span of days, like literally 2 to 5 days. It could even be same day for that matter, depending on how the markets work. Now you can be down the same amount, but you buy through to an option expiration date. And that expiration date is the date when it devalues. And as you get closer to that, it loses value every day. Won't get into the mechanics of why that happens, but there's just a constant devaluation there because you're getting closer to the end date. But if the price, it's a put, and the price continues to drop of the underlying investment instrument, in this case the QQQ, then you're going to be in the money and you can sell that at any time. And that is what I'm suggesting when we have a really green day. Instead of, say, buying a bunch of shares of a company you love, let's just use Apple or Google or Meta or any as an example, with high stock prices, you could buy a couple of calls on those and leverage less of your cash, less of your capital to get in on the potential upside if the market does rebound. So that is a strategy I would definitely consider you having a look at. And the other one is simply to use that from a hedging perspective. If you own stocks, you can do this with the stocks you own or with an ETF that is a basket of those, would contain those stocks in the basket of stocks in that ETF. As we scroll down, there's really not a lot of positive things to look at other than Tesla was up this morning. Tesla could be one of the companies that actually benefits from the auto tariffs because they're less likely to be hit by those. because most of their manufacturing, and well, all of their manufacturing is done in the US for cars sold there. The parts, though, may be coming in, some of them, not all of them, from other areas. So it is likely to be affected, but maybe to a lesser extent. And it has less parts than your typical combustion engine vehicle, which is the primary market share sales volume for your traditional GM, Chrysler, and Ford. So although they've pivoted into EVs, obviously Tesla is EV only, so they have no combustion engine vehicles, and the electric vehicles have traditionally less parts. We look at others. So Meta has had a great run, but it fell yesterday by almost $15.50. It looks like it's down close to another 7.5 today. There is some concern around NVIDIA. Had a horrific day yesterday. I mean, look at NVIDIA. It was off $7 yesterday, down another 2.25 today. And the fear here, even though NVIDIA is clearly a market leader and leading this AI renaissance, the fear is we've now heard from Microsoft in the US, I think through either TD Waterhouse or TD Cowen, but one of those two about a month ago made an announcement that Microsoft was pulling back on some of its data center investments by maybe canceling or postponing some of the leases that it was negotiating. So that was an indicator of maybe too much data center space, which is in contradiction to what that company and Amazon and others were saying at their earnings calls, which was we didn't have enough capacity to satisfy demand, so we need to build out and make investments. And yet we heard that, and that was a third-party report, so take that with a grain of salt. But then we also heard from the chairman of Alibaba this week saying that he believes there's a bit of a bubble starting to develop in that data center space, and there may be more space than is actually required. So hearing those two data points, if we start to hear more along that line, it could slow down sales for NVIDIA. And I mean, NVIDIA has already been slaughtered in the market for where it really should be. It's been penalized. It's definitely in the penalty box, but it could be penalized further. And that could also affect others like Broadcom and TSMC. And we don't know as well with the tariffs what the US administration now is going to do. I mean, TSMC is committed to spend over $100 billion over the next, I think, 4 years in the US to bring some manufacturing back to the US. Is that going to allow them to avoid tariffs? Or are they still going to be affected by tariffs manufactured on products manufactured outside the US? And the same is a potential risk for NVIDIA. It's a potential risk for Broadcom. It's a potential risk for Texas Instruments, for Micron, for Intel. I mean, you name the semiconductor company, they're all potentially affected by this. And that is just going to drag revenue and earnings down. And if we see a slowdown, which we are in the economy, then it's going to pull revenue down further. And that is a red flag. And it seems like the direction we're going in, and it doesn't appear right now that anyone really wants to fix that. That said, through this video, as we head 2 minutes into the open, all three indices are in the red now. The NASDAQ is down 104 and the Dow is down in the 60s. We roll into financials just to close this out. Some of them got obliterated yesterday and had a fairly significant correction. I mean, Apollo was one off 3.25. Looks like it's off again today, although it's had a nice climb back. I think it's going to get back down into the 130s, the low 130s. JP Morgan, down as well, almost $2 in the pre-market. Morgan Stanley off 3 yesterday, off 220 this morning. So that's going to get into the into the teens of the 100, so 119-ish. And then Goldman got slaughtered, down 12. I think it's down, down another 7 today. So I've been buying some puts on these as well on green days, knowing that there's a likelihood going to Liberation Day on April 2nd that these are probably going to claw back as well as the rest of the economy. I'm not dating my expiration on April 2nd because I think there'll be some continued confusion and fallout and tweets and truths coming out of the administration. So I'm picking a date like April 11th. So I've got a little bit of runway left after Liberation Day for things to continue to fall. That is my guidance. I hope it benefits you. I hope you're doing well in your trades. And if you like the videos, please hit the like and subscribe button. Good luck in your trading.